The nature of the game. I have met a great many men in my time who believed they were destined for success in the stock market. They came to Wall Street with the same quiet certainty a man carries when he knows he is fitted for a particular line of work, not by accident or by luck, but by temperament. They told themselves, I have the nerve, I have the judgment, I have the discipline. I am not like the rest. And truth be told, that belief is not a bad beginning. A man ought to have confidence in his abilities if he hopes to accomplish anything worthwhile. But the market has its own peculiar habit of examining a man's convictions. It takes his confidence, turns it over in its hands, and gives it back to him reshaped into something he scarcely recognizes. Sometimes it comes back tempered and stronger. Sometimes it comes back cracked. The street is full of people who want to do well, but wanting has never made anyone a successful operator. It is discipline, that plain, unlovely virtue, that separates the few who prosper from the many who donate. Most people imagine the market demands brilliance. It does not. What it demands is honesty, not toward others, but toward oneself, which is far more difficult. When I first began trading in the bucket shops, I thought the tape was merely a parade of numbers, the day's prices marching by in orderly fashion. I studied it as a boy studies a row of figures on a slate, marking the passage of events without feeling their significance. But as time wore on, I came to understand that the tape did not merely record the market's movements, it revealed its inner life. If a stock hesitated when it ought to rise, that hesitation meant something. If it rose in the face of poor news, that meant even more. But the tape is useless to a man who insists on reading into it what he wants to see. Most failures in speculation begin with a man lying to himself. He looks at a decline and calls it temporary because he wishes it were so. He looks at a rise and calls it suspicious because he sold too soon. The tape is truthful enough, but a man must be equally truthful in reading it. It took years and many costly lessons to understand that speculation is not the art of foretelling the future. It is the art of recognizing the present. If you can see clearly what is, you need no special gift to profit. If you cannot, the market will cure you of your illusions, and usually at a high rate of tuition. This is the nature of the game. You study the market, and at the same time, the market studies you. Only one may afford to be mistaken. 2. The general trend. Before a man can do anything in Wall Street, he must first determine the direction in which the wind is blowing. An experienced sailor does not raise canvas until he knows whether the sea favors him or means to drown him. Yet the average trader rushes to buy or sell without the slightest idea of whether he is working with the tide or against it. There are but two primary trends, bull and bear. Everything else is noise. In a bull market, the path of least resistance is upward. In a bear market, it is downward. A man who understands this simple truth has a chance. A man who ignores it has none. Most people lose because they insist on fighting the primary trend. They imagine they can out-reason it. They point to figures, stories, and opinions as though these mattered more than the movement of prices. They say a stock is too high in a bull market, or too low in a bear market, as if the market were obliged to honor their personal sense of fairness. But the market does not recognize fairness. It recognizes force. If the primary swing is up, you must take the long side or stand aside. If the primary swing is down, you must take the short side or stand aside. I have learned never to argue with the general trend. A man may temporarily oppose a minor swing, but he must never challenge the big movement. It will roll over him as the sea rolls over a drowning man who insisted he could swim against the tide. A speculator does not impose his will on the market. He seeks to discover the market's will and then aligns himself with it. 3. The folly of tips and the truth of the tape. If there is one thing more plentiful than oxygen in Wall Street, it is tips. Tips from brokers, rumors from clerks, whispers from men who have not made a dollar in their lives. Each newcomer believes he is receiving privileged information, but in truth, he is being fed the same scraps that have ruined countless others. If tips were worth the trouble, they would never be given away. A man does not hand you a gold coin when he can buy bread with it himself. In the end, the tape is the only reliable informant. It neither flatters nor deceives. It makes no promises. It simply shows what is happening. And yet, even the tape is useless to a man who insists on telling it what it ought to say. He will interpret a decline as temporary because he wishes it to be so. He will accuse a rise of being artificial because he sold too soon. The tape does not lie, but men lie eagerly to themselves. The tape is the market's autobiography written day by day. If you wish to know the market, read its own words. Fourth, the first loss is the best loss. Every operator, no matter how skilled, must face the fact that he will be wrong, not occasionally, regularly. The difference between success and ruin lies not in avoiding error, but in handling it. The amateur refuses to take his loss. He tells himself it is temporary. He gives the stock one more day, then another. He imagines that by refusing to sell, he is defying misfortune. In reality, he is collaborating with it. The professional does something quite different. Before he enters a trade, he knows precisely at what point the market will prove him wrong. When that point is reached, he sells without complaint or hesitation. He obeys the rule that has saved more operators than any other. Your first loss is your best loss. The amateur is wrong less often, but wrong forever. The professional is wrong often, but never for long. V. Let the market prove your judgment. There is a peculiar habit common to nearly every novice operator. He buys because he wants to be right. He sells because he fears being wrong. His trading is not a dialogue with the market, but a monologue with himself. I know this habit well, for I practiced it faithfully in my earliest years. I believed that if I studied long enough, if I observed minutely enough, I could impose my good judgment upon the market. But the market is not persuaded by a man's confidence. It demands evidence. And until that evidence appears, a man is only guessing, whether he admits it or not. A seasoned operator waits. He waits for the market to tip its hand in his favor. He waits until the stock shows unmistakable signs of strength. Not imagined strength, not hoped for strength, but the kind that expresses itself plainly and consistently on the tape. When that moment arrives, he does not plunge. He enters modestly, as a guest knocking on a door rather than a burglar forcing his way in. The position is a probe, nothing more. If the market welcomes him by continuing in the direction of his judgment, he knows he was right to trust his reading. If it stiffens or recoils, he withdraws with a small, painless loss and waits for clearer signs. There is nothing heroic in this. In fact, it takes far more courage to wait for proof than to act on impatience. To wait is to acknowledge that you do not yet know. Most men cannot bear such humility, but speculation rewards humility far more than bravado. 6. Never average a losing position. I have said before, and will say again, for men seem incapable of learning it, that nothing ruins an operator faster than averaging a losing position. Yet it is the most common error on the street. Something in human nature insists that a mistake can be repaired by repeating it. A man buys a stock at 50. It declines to 48. He tells himself, if I buy more here, I will lower my cost and improve my chance of getting out even. Another decline, and the same reasoning appears. Soon he has transformed what should have been a small, forgettable loss into a large, memorable anchor chained to his account. This practice is not courage. It is vanity masquerading as conviction. The man cannot bear to admit he was wrong, so he sinks deeper into the position that proves it. The market, which may forgive many errors, rarely forgives this one. A stock that refuses to behave after you have bought it is not offering you generosity at a cheaper price. It is warning you, and when the market warns a man, it is wise to listen at once, not after doubling the risk. The professional never adds to weakness. If he must take a loss, he takes it cleanly, while it is small enough to heal without scarring. He would rather regret selling too soon than regret holding too long. A loss accepted is a lesson learned. A loss concealed is only a lesson postponed, and at double the cost.
7. Add only to winners.
Just as it is folly to average a losing trade, it is wisdom to increase a winning one, though few have the temperament for it. There is something curious in human nature. A man will cling to a position that injures him and abandon one that rewards him. He will treat losses like dear friends who must not be abandoned in hard times, and profits like strangers who cannot be trusted to stay. The operator acts differently. When the market shows him favor, he responds with increased commitment, but always in a measured, deliberate manner. Each addition is not a leap of faith, but a recognition that the stock has earned greater confidence. A winning position is not merely profitable, it is informative. It tells you something important about the trend, the demand, the underlying character of the movement. A stock that advances steadily, corrects mildly, and resumes its rise with vigor is asking for companionship. Of course, adding to a winner requires a kind of nerve that many men mistake for recklessness, but it is not reckless to act upon demonstrated strength. Recklessness is acting upon untested hope. A winning position is like a horse that runs well under the whip. A losing position is like a horse that stumbles with every stride. Only a fool would spur the second. 8. Sit tight in the big swing. There are few rules in speculation that every successful operator agrees upon. But of those few, none is more universal, and none more frequently violated, than this. Sit tight. To sit tight is to do nothing when every nerve in your body begs you to act. It is to hold fast to your judgment while lesser men rush about in panic or excitement. It is to understand that the market does not pay for cleverness, but for patience. A great swing does not reveal itself in a day. It unfolds gradually, almost imperceptibly at first. The public, eager for quick results, sells at the first sign of profit. They snatch at crumbs while the feast is still being prepared. The operator behaves differently. Once he has established his line and the market has confirmed his judgment, he lets the movement work. He does not confuse a minor reaction with a reversal. He understands that no trend travels in a straight line, and that interruptions are part of the natural breathing of prices. Sitting tight requires more courage than entering the trade. When you take a position, you face only the market. But when you hold a position, you face the market and yourself, your impatience, your fear of losing what you have gained, your longing to outsmart the trend rather than obey it. Most men cannot bear that pressure. They exit too soon, congratulating themselves on small gains while the real profit marches on without them. They forget that the great operators, the ones whose names are spoken with a kind of reverence, made their fortunes not by constant activity, but by long periods of inaction. The big money, I have often said, is not in the buying or selling, but in the waiting. And it is still true. 9. Buy leaders, not laggards. Every market cycle produces its favorites, a select few stocks that lead the advance with strength, decisiveness, and consistency. You will hear seasoned operators speak of the leaders, and it is no mere nickname. These stocks set the tone for the whole movement. They show the character, the appetite, the confidence of the market itself. Yet the public shuns them. It is too high, they say. I miss the move. I will buy something cheaper. And so they drift toward the laggards, the slow movers, the doubtful prospects, the issues that have not proved anything except that they have been unwilling to rise with their betters. Laggards appear cheap, but cheapness is only the appearance of value, not the substance. The truth is simple. A stock that has shown strength is more likely to show further strength. A stock that has shown weakness is more likely to remain weak. A leader is a stock under accumulation by informed interests. It responds quickly to demand, holds up well under pressure, and resumes its advance with little prompting. A laggard is the opposite. It must be urged, coaxed, and convinced to rise, and most of the time it refuses. A man who buys leaders buys proof. A man who buys laggards buys hope. Hope is cheap. Proof is priceless. X, the pivotal point. There comes a moment in every major movement when the market reveals its true intent with clarity so sharp that a trained operator feels it almost physically, the pivotal point. This moment does not announce itself with trumpets. There is no bulletin, no whisper behind the scenes, no kindly broker leaning over the rail with privileged information. The pivotal point appears quietly, like a change in the weather that only an experienced seaman notices. It may be a sudden advance through a level that has held prices back for weeks. It may be a refusal to decline under heavy selling. It may be strength in the face of unfavorable news, the surest sign of all. These moments signal that the forces of supply and demand have resolved their struggle, and that the dominant trend is ready to resume with new vigor. Those who have studied the stock, watched its behavior, and understood its character will recognize the moment instantly. Most men do not. They hesitate, they debate, they ask for one more sign.
By the time they act, the opportunity is gone.
The operator prepares in advance. When the pivotal point arrives, he needs no persuasion. He acts with the decisiveness of a man who has been waiting for that very moment. 11. The end of a campaign. A great campaign does not end with a crash. It ends with a change in behavior. The tape begins whispering long before it raises its voice. A stock that once advanced readily now hesitates. A stock that once held firm now breaks more easily. A stock that once revived quickly after reactions now takes its time returning to form. Then come the more telling signs. Heavy volume on declines, light volume on rallies, sudden spurts of strength that fail to follow through. This is distribution, the quiet unloading of stock by those who understand the game best. They do not wait for the public to recognize trouble. By then it is too late. To the untrained trader, these signs appear insignificant. To the operator, they are unmistakable. He does not argue with them. He does not wait for confirmation from newspapers or brokers. He does not cling to his position out of greed. He recognizes that the campaign is ending, and he withdraws with the same discipline with which he entered. A man who waits for disaster will surely meet it. 12th, the market campaign. A proper speculative operation is not a series of disconnected trades, but a unified campaign, a military operation conducted with reason, patience, and precision. It begins with reconnaissance, studying the general trend, identifying the strongest groups, and selecting the leaders within them. This stage alone may take weeks, while the public exhausts itself in constant buying and selling. Then comes the first engagement, the test buy. A small line placed carefully, not as a commitment, but as a question. Is my reading correct? If the market answers yes, the operator advances. If it answers no, he retreats without shame. As the campaign progresses, he adds to his position, never recklessly, always in response to demonstrated strength. He builds his line the way a general extends his forces, methodically, never exposing himself more than circumstances warrant. Then comes the long, silent period in which the campaign earns its reward. The operator does little. He observes, he waits, he lets the trend carry him. And when the character of the market changes, he concludes the campaign with the same deliberate calm with which he began it. There is nothing flashy in this method, but there is immense profit. 13. The enemy within. Ask any operator who has survived more than one cycle what the greatest danger in speculation is, and he will not say manipulation, inside information, or sudden news. He will say, myself. The market does not break most men. They break themselves. A man may forgive many faults in others, but he is ruthless in protecting his own illusions. He will cling to a losing position because selling it would mean confessing he was wrong. He will sell a winning position because holding it would mean tolerating uncertainty. He will study every movement of the tape except the ones that contradict his opinion. Fear makes him cautious when he should be bold. Greed makes him bold when he should be cautious. Impatience makes him act when he should wait. Stubbornness makes him wait when he should act. The market has no greater adversary than the human mind left to its own devices. That is why the operator's first and greatest task is self-mastery. He must build habits stronger than his impulses, discipline stronger than his whims, and humility strong enough to withstand both success and failure. He must learn to obey his rules even when his heart clamors for disobedience. Success in speculation is not achieved by conquering the market. It is achieved by conquering oneself. 14th, the final lesson. When all is said and done, speculation is not a matter of brilliance or daring. It is a matter of character. A man must study the trend so he is not misled by noise. He must trust the tape so he is not deceived by stories. He must take his losses quickly so they do not take him. He must add to strength and abandon weakness. He must sit tight through the long swing and leave the field when the movement ends. If he learns these lessons from words, he may save himself many years and many dollars. If he refuses, the market will teach him, as it taught me, slowly, sternly, and at a price he will not soon forget. And when he has learned all that the market can teach, he will understand the final humbling truth. A man studies the market for years, yet it takes only moments for the market to reveal who he truly is. That, gentlemen, is all.